Hi, everyone. For this presentation, our team is a group of real estate investment analysts hired on by a Japanese investment group known as KRL Capital. KRL Capital is looking to expand their operations onto the West Coast and sent our team this investment listing of a commercial office property located in San Diego, California. The office property has abundant amenities served by 9 surrounding retail power centers that are all within a short driving distance from the property. Within 3 miles, there are plenty of restaurants, bank locations, grocery stores, health fitness centers, and hotels. And the average annual household income is over $129,000, which puts this property in an excellent demographic area. This is a 2-story Class B office property, given that the building was built in 1980. The property has 3 access points and provides all employees and guests with ample on-site parking. The property currently has 100% occupancy with major tenants such as Pacific Crest Legal Partners, Coral Biotech Innovations, LaJolla Financial Associates, and West Coast Venture Capital. The seller's asking price for this location is $15 million. Operation cost of this property totals to $214,000, which will include the property taxes, insurance, maintenance, and utilities. The management fee is 3% of the effective gross income, and even though the property is 100% fully occupied, the seller asks for a 5% vacancy loss for any unforeseen vacancy. There will also be a 2% of the effective gross income in its capital expenditure reserve, and the CPI will increase rent for the tenants by 3% annually due to inflation. With a 30-year amortization period, the bank agrees to provide KRL Capital with a 65% of the loan at an interest rate of 5.5%. The KRL Capital will have to pay back the bank in 10 years and are expected to pay the 1.5% lender points. Once acquired by KRL Capital and held over the 5-year holding period, we can expect a going out cap rate of 8% for the new buyer, a cost of sales rate of 3%, and commission rate of 2%.
Here we have the performance evaluation. As you can see, our levered and unlevered, both low to moderate, MPV, levered, unlevered, moderate, cash on cash, levered and unlevered, moderate. Typically, these fall in the range of, as the slide states, low to moderate, which is good. It's on the low end, but still it's in the green.
Okay, and these are our implications of an 8.5 interest rate. Our new levered before tax IRR is a 6.19%. Our new unlevered before tax IRR is a 7.84%, which is the same as before. Our new levered before tax NPV is a negative $1,072,322, and our new levered cash on cash return is 3.97%.
To obtain an 11% internal rate of return with that interest rate being raised from 5.5 to 8.5%, we would be able to offer a maximum purchase price of $14,280,000. This would give us our 11% internal rate of return with a cash on cash return of 5.5%.
With the interest rate going up, that means higher annual payment, which reduces the amount of annual income that flows through to the investor. Our targeted rate of return also drops from 11 to 6, making it less than ideal for maximizing returns. In my opinion, I would still acquire the property with debt instead of equity, considering that it's a lower risk investment than equity. It would already be less than our targeted rate of return, so inherently more risky, trying to minimize risk giving our new figure. Equity would get all the upside, but also the downside in not trying to put investors in that position.
So our recommendation would be to raise the price to additionally $385,000 in order to reach the 11% internal rate of return. We would also buy levered. This would give us a greater internal rate of return for buying.